Okay, so imagine this. You're scrolling through financial news, maybe checking your own investments, and this one name keeps popping up, Take-Two Interactive Software.
Right.
You've probably seen the headlines about their stock. It's just, well, it's gone through the roof.
Absolutely soaring, leaving major indexes like the S&P 500.
Yeah, the big benchmark for U.S. companies.
And the NASDAQ, the tech one.
Way behind. It's that kind of performance that makes you stop and ask, okay, should I be getting in on this?
Exactly. That's the immediate reaction.
So today, that's what we're doing, a deep dive into Take-Two. And our goal isn't just to talk about that impressive stock chart.
No, definitely not.
We want to help you figure out if, beyond the hype, it's actually a smart investment for you, for the long haul.
Looking past the momentum.
Yeah, we need to get past the flashy numbers and really understand the business itself. Where does the money actually come from? Do the fundamentals back up this market enthusiasm?
And that's so important because, look, chasing that kind of momentum is tempting.
Oh, absolutely.
And Take-Two definitely has it. Their stock gained, over 55% in the past year through late 55%, yeah, compared to like 13% for the S&P 500 and maybe 14% for the NASDAQ. Huge difference.
Massive difference. But just buying because something shot up like that, that's usually not a great long-term plan. You've got to know what's actually driving it underneath.
Couldn't agree more, which is why we need to dig deeper. Go beyond just the share price.
Right.
We need to unpack the actual business, look at all the ways they make money, check their financial health, and crucially, talk about valuation. Is the price tag justified?
Exactly.
So let's start right there. Fundamentally, what is Take-Two Interactive Software? What do they actually do?
Well, basically, they're a giant in the video game industry. They create and sell games.
Okay.
But we're not talking small indie games here. They own some absolutely massive, globally recognized brands. Think Rockstar Games, 2K, Zynga.
Ah, okay. So names people definitely know.
Oh, yeah. Rockstar means Grand Theft Auto, Red Dead Redemption, huge sellers.
Right, massive franchises. And 2K has the NBA 2K series, Borderlands. Zynga brings in the mobile gaming side, too.
Got it. And where do these games end up? Consoles? PCs?
All of the above. They develop for consoles like Microsoft's Xbox, Sony's PlayStation, for personal computers, and importantly for smartphones, too. Their reach is incredibly wide.
So they've definitely got the blockbuster hits covered, the big initial sales. But you mentioned something interesting earlier. It's not just about selling that first copy of the game anymore, is it?
Not at all. And that's where Take-Two, and frankly the whole industry, gets really interesting from a business perspective.
How so?
They've really leaned into diversifying how they make money after the initial sale.
Okay.
So think advertising within games, players buying virtual items like cosmetic upgrades or special gear.
Right, microtransactions?
Exactly. And revenue from virtual currency used within the game.
Yeah.
It's a whole ecosystem beyond just buying the disc or the download.
And they actually have a term for this, right? Recurrent consumer spending.
That's the one. It's a key metric for them.
And looking at their last fiscal year, the one ending March 31st, this recurrent spending was, get this, over 79% of their total revenue.
79%. Yeah, it's enormous.
That's a massive chunk. What's the significance of that? Why is that so important?
Well, think about it. Selling a big new game creates these huge revenue spikes, but they depend entirely on launch timing. It's lumpy.
Right, feast or famine sometimes.
Exactly. But this recurrent spending, it's much steadier. It's people continuing to spend money inside the games they already own. It provides a much more predictable, consistent flow of cash.
Ah, okay, so it smooths things out, builds a more stable financial base.
Precisely. It's a much more resilient business model than just relying on hitting home runs with new releases every single time.
And that stable base seems to be fueling their overall growth numbers. Let's talk revenue momentum.
Okay.
Fiscal fourth quarter, using GAAP, the standard accounting rules revenue grew 13% to $1.6 billion.
Decent growth there.
And that recurrent consumer spending we just talked about, that was up 9% within that.
Solid.
For the whole fiscal year, total revenue climbed 5.3% to $5.6 billion. And looking ahead, management thinks they can hit around $6 billion this current year.
So the top line is definitely moving in the right direction. $6 billion is a big number.
It sounds really strong, right? Revenue growing, lots of recurring income. But here's where it gets a bit puzzling.
Okay.
Despite all that revenue coming in, the company is actually reporting losses, big losses, under those same GAAP rules.
Wait, really? Even with almost 80% of revenue being that steady recurrent stuff?
Yeah, that's the paradox. It seems counterintuitive.
It really does. How significant are these losses?
Well, under GAAP, they lost $4.5 billion last fiscal year.
Billion with a B.
With a B. And importantly, that's after backing out some huge sort of one-off $3.8 billion impairment charges. Think like write-downs on assets.
Wow. So even excluding those big hits, the underlying loss was still massive.
Exactly. And what's maybe more concerning is that the loss was actually wider than the $3.7 billion loss the year before.
Oof. So revenue's going up, but losses are actually increasing. That's not the trend you want to see.
Not typically, no. Despite selling more, they seem to be burning through cash faster, at least according to GAAP. And they're forecasting another loss for this current year, somewhere between $439 million and $499 million.
So still in the red. Okay, this is a critical point. Revenue growth is one thing, but profitability is another beast entirely.
It absolutely is. So given these GAAP losses, how do they talk about their performance? Is there another lens they use?
Yes, there is. And management often highlights this other metric. It's called EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization.
Exactly. It's meant to give a cleaner view of core operational profitability by stripping out things like non-cash charges, depreciation, those big impairment write-downs we mentioned, and also the impact of debt costs and taxes.
Kind of like the business's raw earning power.
That's a good way to put it.
Yeah.
And on that basis, using EBITDA, they reported about $199 million last year.
Okay. Positive, at least.
Positive, yes. But that was actually down from $272 million the year before. So even EBITDA slipped year over year. But here's the interesting twist. Most of that $199 million in EBITDA came just in the fourth quarter.
Oh, okay. A strong finish, then.
A very strong finish by that measure. And looking ahead, management expects this year's EBITDA to, well, skyrocket is maybe the word. They're forecasting $508 million to $562 million.
Wow, that's a huge jump from $199 million. So they see a big improvement in operational earnings, even if the official GAAP profit isn't there yet.
That seems to be the story they're telling, yes. A big turnaround in underlying operational performance is expected.
Okay, so that leads us to valuation. If they aren't profitable under GAAP, you can't use the standard price to earnings or PE ratio, right?
Correct. No earnings, no PE. Doesn't apply.
So what do you use instead?
You have to shift to something like the price to sales ratio, the PS ratio. Basically comparing a company's total market value to its annual revenue.
And what does that tell us about Take-Two, especially after that big stock run-up?
Well, it tells us the valuation has gotten significantly more expensive. The shares currently trade at a PS ratio of about 7.5.
7.5. And how does that stack up? Is that high, low, average?
It's definitely on the high side. Just a year ago, it was around 4.5. So that's a big increase.
Right. And compared to the overall market?
Good question. If you look at the broader S&P 500 index, its average PS multiple is currently around 3.2.
Okay, so 7.5 is more than double the average market multiple.
Yeah. And even the tech-heavy NASDAQ composite is sitting around 6.6. So Take-Two is trading at a premium even to the NASDAQ average.
Wow. So a PS of 7.5 implies investors are expecting, what, some really stellar growth ahead.
Pretty much. They're baking in expectations of very strong future performance, likely including significant growth and eventually profitability.
But you mentioned management is only forecasting about 7% revenue growth for this coming year.
Exactly. And that's the potential disconnect. A 7.5 PS ratio is pretty rich if revenue growth is only expected to be in the high single digits next year. It suggests the current price might already reflect optimism that goes beyond the company's own immediate forecast.
Which brings us to the elephant in the room, or maybe the most anticipated video game ever, Grand Theft Auto.
Ah, yes. GTA 6.
We know a new version is coming, scheduled for release in May 2026, right?
That's the current target, yes. Spring 2025 originally, now pushed to fall 2025. Apologies, I misread my notes there. Fall 2025 is the window.
Fall 2025. Okay. That could absolutely juice next year's revenue growth, right? I mean, dramatically.
Oh, undoubtedly. A new GTA release is a massive event. It's probably the single most anticipated game release, period. It will drive huge
I
sales.
feel a butt coming.
Well, the but connects back to that valuation. Many analysts watching the stock believe that a successful GTA launch is already essentially priced in.
Meaning the high PS ratio we just talked about already assumes GTA 6 is going to be a monster hit.
That's the argument, yes. Based on where the stock is trading now, investors seem to have largely factored in that massive revenue boost already. You're paying today for success that's still over a year away.
So the upside from GTA might already be reflected in the current share price.
It's a strong possibility. according to the analysis we looked at.
Yeah.
And ultimately, for building long-term value for shareholders, the real key isn't just one blockbuster release.
It's about profit.
It's about consistent profitability. That's, as the analyst put it, the name of the game. Companies that reliably generate profits are generally seen as building sustainable value. Those that don't, well, they can destroy it over time, even with popular products.
So bringing it all together then, for someone looking at Take-Two stock right now, considering the big run-up, the valuation, the lack of profit, what's the takeaway from our sources?
Given how much the stock has already climbed, combined with the current lack of GAAP profitability and that high valuation, the analysis we reviewed suggests maybe holding off for now, staying away from the stock at its current level.
Okay, so let's wrap this up. What does this all mean for you, the listener? We've explored Take-Two Interactive Software, clearly a major player in gaming.
Huge franchises, yeah.
Strong revenue growth driven significantly by that very sticky recurrent consumer spending, which is almost 80% of their business now.
A really impressive metric.
But on the other side, you have these significant GAAP losses year after year and a valuation measured by price to sales that looks quite high compared to the market, perhaps already factoring in the massive success expected from Grand Theft Auto 6 next year.
There's real tension there.
It really is. So the final thought we want to leave you with is this. How much weight do you give a company's potential fueled by things like that loyal recurrent spending and huge future releases versus its current lack of actual profit? Is the future always fully baked into today's price, or could there be hidden opportunities or maybe hidden risks that the market isn't quite seeing yet? Something definitely worth mulling over.